All right, this is Greg Traynor with Wyndham-Lyons Realty Services. This is Keeping It Real Estate, and this is the November 2022 edition. I am here with my guest, Jason Gordon with AmeriFirst Financial. Jason is a certified divorce lending professional. He's located in San Diego, California. He is again, certified divorce lending professional, or CDLP. Jason focuses his practice on helping divorces homeowners make a more informed decision regarding their home equity solutions. And with the divorce team, he helps identify any potential conflicts between the divorce settlement, the mortgage, and the real property. I am welcoming right now, Jason. Welcome, and thank you for joining us.
Thank you for having me.
Great. I think today we're going to be talking about how this environment, the tumultuous environment and the very unstable and hard to predict issues with interest rates and the real estate are going to affect our clients, which are both the attorneys and the folks that are involved in the litigation with divorces. Particularly the ability for one spouse to buy the other spouse out. Many times there's a spouse that wants to keep the property and they're faced with a court order that says you've got to refinance the property within a certain period of time. And there's some pitfalls to that. And that's what Jason is a professional at doing, is making sure that those pitfalls don't place your client or you in a bad position. So Jason, I'll let you take it from there and introduce yourself.
Well, sure. Well, thank you again for having me, Greg. I appreciate that. Again, my name is Jason Gordon. I'm a residential mortgage specialist with an emphasis in helping divorcing homeowners, home buyers, and really partnering with the divorce professionals involved. There's a lot of collaborating that we can do to better service our mutual clients. So about a third to just under half of my business does deal with divorce specifically. I always say I don't just service divorcing folks. So if you have clients that are happily married or single, we can help them out too.
Wonderful. Thank you. I think the first thing that we want to talk about that affects everybody is some of the trends in the market right now. And like I just mentioned, the interest rates have been crazy this year and driving us crazy. So Jason, I'm hoping you can let us and the folks that are viewing know what's happening, has happened so far this year, what's happening today, and what we're predicting coming up here in the future.
Absolutely. Well, if I can do a screen share, I'll be happy to show a visual to help the audience kind of see. While I'm waiting for that access, I'll just summarize by saying that there are two different ways we each pay when we get a mortgage, regardless of the circumstances: refinance, purchase, divorce, or not divorce. We have the upfront cost and we have the interest rate. That combination we call pricing, and that pricing is constantly changing. And if one of us are applying for a loan, at some point we do lock in for a period of time to complete the process of getting the loan. But we are always reminded just how small we are in this world when we realize that the market moves, no matter what we have kind of pending, whether it's an active case, whether it's our own personal loan. And right now, a lot of these divorce equity buyouts, which we'll talk about a bit more as we move forward, a lot of the complexity of the numbers involved have changed profoundly. And as a result, obviously, we have to pivot with those number changes and as that works. So I think I'm getting access to the screen right now. Greg, can you see my screen?
I sure can.
You see the actual, okay. Sorry, I'm having a hard time seeing on my end. So this is public record. I mean, any of you can log on here. This is data from the government showing average interest rates over the last 50 years. This is spotlighting 30-year fixed mortgages. A friendly reminder, you don't want to just go on this site, point to the present day and quote a rate. If you don't have an NMLS ID, that's actually against the law. And as we all know, I mean, there's different rate quotes for different borrower profiles, but this trend or this image really just shows you just how sporadic interest rates can be. And again, over a 50-year period, if I hover over kind of present day here, or the most recent, reporting date, we're somewhere in that 7% range, give or take, which if you look at the last 50 years, that's really not that high. Look where where this image is right here compared to the last 50 years. But so many of us want to compare the present day to what was going on just during the pandemic, around 2 years ago when rates were in the twos. And so a lot of divorce equity buyouts that are currently in process now were started somewhere in that pandemic era, or maybe just it's always hard to know when that pandemic actually stopped or if it stopped. But we are comparing a lot of clients that were in the twos and threes to now with rates in the sixes and sevens. That does change the math. And again, we're going to go over a case study shortly to really show just how much that math has changed. But this visual can really show you the trends.
Yeah, and it really makes a point out of how we've been dropping an interest rate. And I wasn't in the business in the early 80s, but you can see where those rates were. I'm second generation in the business, and I remember eating a lot of ramen noodles during the early 80s when the interest rates were that high. My father was a loan officer, and my mother worked at a bank that did in the mortgage department. So we've been fairly spoiled since the 80s, and that slow decline, it's compressed there, but there's ups and downs throughout those years. But if you look at the last 6 months, that jump has been extreme. So even though historically it's not what we've seen in the past, and it's lower than what we've seen over the years, and I've been in the business for 35 years now, it's that quick jump that really catches people off guard, I think. I'm sure you would agree, Jason. And really, that's what we're here to talk about today, because a lot of the folks that may be involved in the divorce, that quick jump makes all the difference in the world. And you're going to go through that in your case study. And so the folks that we serve, which is the attorney community and the divorcees, this quick jump right here is something that we need to make sure that we're looking at, as well as what I'm going to cover here real quick. Jason, if you want to just shoot me back over the control of the screen so I can pop up my little quick market update on the real estate side for everybody. I'm going to be looking at as I pop up my screen here.
Yeah, give me 1 second. I'm just trying to stop the share. Okay, it should be all yours.
Awesome. So I'm going to go ahead and share my screen. And we're going to pop up here. So we've heard from so many different sources right now. People get ranks. People like bad news. They like to terrify people. They like to put sensational headlines on everything because it gets more views and it gets more clicks. You got to be cognizant of who you're listening to and what those data sources are, and if there's somebody that's just trying to get clicks and views on their systems. But we pull our data from national economists and our data not only nationally, regionally, and locally from our MLSs that provide that data. But this is a great quote from Jason Lewis, who is the CEO of Parcel. In the absence of trustworthy, up-to-date information, real estate decisions are increasingly being driven by fear, uncertainty, and doubt. And those decisions will have huge consequences for consumers and businesses. So what I'm going to provide for you guys today is some information on days on market. And the same thing as Jason did is showing some historical perspective on these, because as you can see down here, we have the current place that we're at. And this is days on market. And this is, you list a property, how many days would you expect that home to be on the market before you go under contract? And these are regional numbers, hyper locally. If you're in Northern Kentucky and some of the markets, or Cincinnati side of the river, some of these numbers are much lower. We weren't days on the market. In some cases, we were hours on the market before those properties went pending. But you can see the trending upward from earlier this year as we go from regional average of 14 days on market all the way to 19 days on market. And I say that because historically speaking, even back to just a couple years ago, we were 49 days on market, 42. I would say we've averaged somewhere around 35 days on market over the last few years if you had to blend those. And then if you go a little bit further out and show what the inventory is in past the days on market. Inventory is indicative that if no more homes came on the market, how long would it take to exhaust, and at the sales pace that we're at, all the homes that we have right now. And you can see again, at some points, and this is regional, so the numbers are a little bit higher, and some of the markets in Cincinnati, we only had 18, 19 days of inventory. So they were being gobbled up and consumed, and we had multiple offers and everything, but we've been trending up, and regionally we're about 23 days on market now. But look again, historically, 2.3 months worth of inventory. If you look back in our market since 2019, very healthy markets. We're still much shorter inventory than we had back then. And as you can see, again, in this short period of time, it almost matches with those interest rates that Jason was going over in those graphs. Our months worth of inventory, even though it's starting to climb a little bit, we're much lower than we've been historically. Look all the way back at 2011. And Jason, I know that you were in the business then. That's when we first started coming out of the Great Recession and the housing crisis that we had back then. We had upward of 10 months worth of inventory as an average. And if you're feeling like that's where we're going today, it's really not the case. You can see that we're well below that. So this is demand. This directly reflects what demand is still showing out there. And same thing, we're talking about inventory is supply, days on market, and the other graphs that we're showing are demand and supply. So we see these graphs are simply telling us that when it comes down to it, the inventory levels really aren't where we expected them to be. So if you think that just because the buyers are slowing down a little bit in their home purchases, that inventory should be getting out of control, that's truly not the case. The inventory just is not rising at the same pace. So our point, without just beating everybody to death, with these graphs, we can see that even though the traffic to the houses right now continues to decline, and it's still above, and we still have more people looking for homes right now than it was at pre-pandemic levels. So a very healthy market still in greater Cincinnati. And what I compare it to, Jason, is anybody that's been on, taking a vacation trip, and the kids go to sleep, and maybe your spouse goes to sleep, and maybe that gas pedal gets pushed a little bit harder down to the floor, and you're going really fast to get there. And then everybody wakes up and you slow down a little bit, and you go from 80 miles an hour, maybe down to the speed limit of 65. You feel like you're crawling. You feel like you're going super slow, and you're not. You're just going the speed limit. And I think that's what a lot of people are experiencing right now, is that we are going the speed limit right now. It's a normal pace. We're getting more back to a more typical pace of the market, where people put their houses on. People have opportunities to see those homes, make offers, and go through it at a normal pace, instead of running around like our hair's on fire, making crazy offers on homes that are over, and contingencies that are eliminated, like appraisals and inspections and stuff like that. So just to go through here and talking about some recession, I just want to point out real quick too, a couple items, what we're walking into. Even though that we're predicted, we may already be in a recession according to economist rules, but according to our government, we're not. But even if we do, I just want to just quickly point out what a recession means to your home equity. And in the last 6 recessions, only 2 of those 6 resulted in home equity being lost or prices falling on homes. During 1991, so it was a very slight, if any. And then the big recession, which was in 2008, we lost about 20% nationwide. Locally here in greater Cincinnati, northern Kentucky, it was more like 35%. But by 2014, we had gained those back. And this is for you, Jason, and you'll talk about this a little bit about what's happening in the future. People equate recession with high interest rates. That's not always the case. And especially, again, In the last 6 recessions, interest rates have dropped. So if we pair those two things together, what we're going to see is in the next year or so, we're going to have a stable environment with the price appreciation and maybe some dropping interest rates that'll help out in a low inventory environment and the supply staying steady. I think that's going to put some pressure on home prices upward again. So yeah, I'm going to stop boring you guys to death with economics, and so we can move on to the reason why you're here. But I just wanted to indicate to everybody, for those, and this is Chief Economist for Redfin, Taylor Marr, as quote, "For those bearish folks eagerly awaiting the home price crash, you're going to have to keep waiting. As much as demand is pulling back, supply is as well, reducing downward pressure on prices in the short run." So just a quick where we've been, where we're at, and where we think we're going in the industry. I think it's a very sober look, and we're not trying to be either panicking people or being irrationally exuberant, I think is the term that's used sometimes in our industry for people that we don't want people to get too scared and keep buying and selling houses. So I think we're right in the middle with our advice that we're given to everybody on that. So I'm going to turn this over to Jason. He's going to have some case studies and talk about the meat and potatoes of why we're here, of how this environment is affecting you as an attorney or you as a divorcee, and being able to buy out your spouse if you want to keep the home, and some of the things that you can do to prevent the pitfalls that could occur if we're not talking to those people or putting a team around ourselves to make sure that we can successfully execute those court orders or those agreements that we have in divorce and dissolution situations. So Jason, I'm going to hand this back over to you, and just bear with me for just a second while I think you might still have some control. Can you get there, Jason?
Let me check and see here. Okay, can you see my screen now?
It's not popping up yet. We're going to figure this out.
Oh, you know what? Hang on. Now, can you see my screen?
Yes.
All right.
There we go.
Okay, sorry about that. That was me failing to hit one extra button. So I'm a lot better at doing loans than I am operating Zoom. So I apologize about that.
No podcast or Zoom meeting would be complete without some type of technical glitch.
Isn't that the truth? Huh? So
Yep.
a little
Makes it
blooper
fun.
here. A little blooper here and there shows we're human, right? So
That's
okay.
right.
You see on the screen here, legal disclaimers. As long as it's flashed up on here, I'm compliant. But just to point out, my NMLS ID is 259027. This is an educational presentation with examples, with rounded numbers, not an offer to lend, no legal tax advice. We're just having a conversation here about education. So here's information about myself. I won't go over every single bit of this. It's just background on who I am. What I want to point out are those 4 credentials in yellow font. You may or may not be aware that there are actual real estate and mortgage professionals who have sought out extra proactive training to better serve divorce and home buyers, homeowners, and of course, divorce professionals, primarily legal divorce professionals. Without going into every single one of these, I'll just say that humbly, I am the only person in the country who's gone through all 4 of these credentials. I have a unique position to speak very objectively about the pros and cons for each. I would just say that the first one here, the Certified Divorce Lending Professional, or CDLP, really is the most proactive and intense comprehensive training for mortgage lenders. The CDRE, which both myself and Greg have both earned this credential, is, in my opinion, the most comprehensive education for real estate professionals. The CDS is a great way to incorporate all the professions and all the divorce professionals through the National Association of Divorce Professionals. And then the RCSD is taught by a law school professor. I do have permission from the Divorce Lending Association to show you this image, which is the cornerstone of the CDLP curriculum. Now, I want you just to look at this because it really shows how myself and how Greg can really come in and help out the process here. So to kind of summarize this image, nearly every divorcing homeowner has at least 4 puzzle pieces that must be connected before the divorce is finalized. And as we see here, we have divorce law, first and foremost, which we all know this process involves the courts, contracts, a judge, oftentimes some of you folks. IRS tax law is number 2. There may be significant tax implications for selling real estate, receiving alimony, liquidating retirement accounts. Now, the fact that I referred to this population as divorcing homeowners implies that real estate is involved, which is puzzle piece number 3. And where there's real estate, there's usually questions about mortgage financing, which is puzzle piece number 4. Now, here's where we believe the problem exists. If you look carefully at this image, you'll notice that these puzzle pieces are not yet connected. This is symbolic. The reason they are not yet connected is due to the typical behavior protocols of the 4 professionals involved. In this case, family law attorney, CPA, real estate agent, mortgage lender. These professionals typically do not collaborate with each other throughout the divorce process, which shifts the burden of connecting these pieces directly to the divorcing homeowner, who is typically not an expert on any one of these pieces, much less all 4. And by the way, they're going through an emotionally traumatic process and might not always be thinking clearly. So to summarize, we believe that as professionals, we can do better and we should do better. And so as you can see, 2 of those pieces right now are presenting in today's presentation. CDRE, CDLPs are not household names like CPAs are, but in this case, I just want you folks to know that there are people out there that are trained proactively to help this population out. So I'll move on. If I was teaching you algebra today, I would begin with a bit of math. So I'm going to go through these slides very quickly. If you're driving, you don't have to look at these slides. But if you are and you can see these, it'll just reinforce what I'm saying verbally here. No matter what the situation is, purchase, refinance, divorce or not divorce, mortgage lenders have guidelines to approve you. And at the heart of these are 3 categories: credit, equity, cash flow. We assign a abbreviation or an acronym to each of these. We have credit. We all know FICO scores. Equity, we have what's called loan to value or LTV. In cash flow, we have what's called a debt to income or DTI ratio. We all know credit scores are important. The higher the scores, the better. What you may not know is that Fannie Mae and Freddie Mac have what are called tiers, as in TIERS, certain brackets of scores, which are going to determine how they risk assess a borrower. Equity, we have an equation. It's called loan to value, which we abbreviate LTV. Quite simply, loan amounts on top of the fraction, property value on the bottom, you divide the 2. So if a property is worth $1 million and they borrow $800,000, 800 divided by $1 million, they're at 80% LTV. They would be considered more risky in this category versus somebody who's borrowing $600,000 with $1 million value. That would be 60% LTV. So as you can see here, the lower the LTV, the less risky the borrower appears to be in that risk scrutiny. And last but not least, we have the debt to income ratio, the DTI, which I'm going to go over really quickly because it's really at the heart of all of these qualifications and at the heart of my urging of you to update your divorce equity buyout approvals right now, because the market has changed. And at the heart of these approvals or these declines is the DTI, that debt to income ratio. So you see this is a fraction again, debts go on top, income on the bottom, you divide the 2, you get a DTI. So what goes on the top of that fraction? Well, on the debts, we have the proposed new housing payment to include property taxes, homeowner insurance, any HOA dues or Melrose assessments, along with any other debts that appear on the credit report. Now, if our borrower is the payor of support, we're going to use that support amount on the top where the debts are. You see that's in red. Now, on the bottom of the fraction where the income is, there is a different income calculation for every type of income source, whether you're a W-2 wage earner, self-employed, retired, and you see at the bottom here, if our client is receiving support and using that receipt of support to qualify, that goes on the bottom of the fraction. So as a quick example here, let's say our borrower makes $10,000 in the bottom of the fraction, nice, easy numbers. Their total housing payment and what's on their credit report is $4,000 plus $500. We have $4,500. They're at a 45% DTI. They're going to qualify in most cases. That is a suitable DTI. But what if we take the same situation and we add $2,000 in support payments to our client's debts? Again, this is if our client is the payor of support. Well, now that 4,000 plus the 500 plus the 2,000, we're at 6,500 divided by 10,000 of income. We're at a 65% DTI. That will not garner an approval in any programs. Now, what if our client was the payee of that support and we're keeping the debts at 4,500, adding the 2,000 in receipt of that support to the 10,000 that they already earn? We have a very low DTI here, and that would pass in any situation. So just to give you a correlation of this, of how these debts all show up. So now the case study I'm going to go over with you, and these numbers are rounded to the nearest dollar, but I think you'll find that it summarizes what really can change between initial consultation and the completion of a process here. So in this case study, I met with the in-spouse, in this case, the wife, who was desiring to keep the home. We met on August 3rd, 2021. Again, she is the in-spouse desiring to keep the home. He's the out-spouse moving out. As most out-spouses want, they want two things. They want to be removed from the liens, and they want their share of the equity. So in this particular case, the home value as of August of last year, $500,000. The existing mortgage was $300,000, therefore $200,000 in equity. Again, he wanted, as the outspouse, to be removed from that $300,000 debt. He wanted half of that $200,000 of equity. So she was seeking an equity buyout loan of $400,000. And I'm aware that we do put closing costs in the back of these loans. Just for logistics, I'm going to go over just these round numbers here. So her income, when we looked at her actual salary income, was $4,100 a month. That was not sufficient income to qualify from that DTI perspective. Now, fortunately for qualifying purposes, he was going to be giving her $3,450 in child support that was going to be starting just a few weeks later on September 1st of 2021. When I pulled her credit score was 740, top tier, which is great. And back then, mortgage rates were at 2.75%. So when I did the calculations again on August 3rd, we looked good. We had an approval in place. Now, what bears noting is for us to count receipt of support payments as the payee, we have what's called what I like to call the rule of 636. So as attorneys, you all know the importance of very clear and concise, non-ambiguous orders, because obviously these have to hold up legally. And in the lending world, we have what are called underwriters, which are basically forensic accountants, kind of like our version of CDFAs, where they don't take ambiguity lightly. They're not going to take the ambiguity and sort of yield to what you want to have happen. We're assuming clear orders between payee and payor, and then that establishes a baseline for us to know what the agreement is. Now, we want to know that the payor is paying as agreed. So we want to know who the parties are, when the support's going to start, when it's going to end, and how much is in consideration monthly for that support. So we have, when I say the rule of 636, we want 6 months of historical receipt. When I say historical receipt in 6 months, we want that money to be traced back to the payor's account. In this case, he's paying her. That money cannot come from a joint account in both of their names, because if it is, then essentially she's paying herself. We cannot count that. We want stability. We want to make sure that this is something that we can not only trace back to the payor, but know that the payor is paying as agreed. If he's going to pay her $3,450 a month, that's how much we need each and every month, not $5,000 one month, $2,000 another month. And we want to trace from something that we can see is his account. So no Venmo, no Cash Apps, no PayPal. We want it to come from his account or an automatic clearinghouse debit or a wage garnishment, something that we can trace back to him very clear and concisely. Now, let's just say that he wrote a bunch of bills on her behalf on any given month. Say he paid $1,000 worth of utility bills. He cannot subtract that from the amount that's agreed to. He'd have to pay her the full amount that was agreed. She can reimburse him on a separate transaction for that $1,000 that he fronted to make him whole. So a lot of these things kind of violate just life logic, but lender logic is going to prevail here. They have guidelines, they have to be followed. So the 6 here is 6 months. Yeah, Greg, you're muted, my friend.
Quick question for you, Jason,
Yes.
on that, because that's something that happens every once in a while. When you're talking about that 6 months, if somebody in the 5th month, they decide that they want to do the bartering, and like you just mentioned, somebody pays a bill, so they reduce the child support or spousal support, does it reset that clock back to the 6 months again? Or
sadly, it does.
okay,
So they want to see 6 consecutive, the most recent 6 months or more consecutive, paid as agreed on time for it to count. So yeah, sadly,
that's huge. That's huge.
Sadly, what you just outlined does happen sometimes.
Yep.
And this is where, again, where life logic and lender logic kind of clash a little bit, and sometimes lawyer logic, all this kind of, we can make a case in the court of public opinion, but in the end, Fannie Mae, Freddie Mac underwriting guidelines are going to prevail. And they're very clear on that consecutive nature of that money. Now, notice I mentioned 36 as well. This is continuance into the future. We want to use the funding date of the loan and then measure 36 months after that to know that that support will continue. So if you think about alimony or spousal support, if it says, let's say he's going to pay her until one of them gets remarried and or becomes deceased, that automatically qualifies for the 36 because we lenders cannot attach a date to someone being remarried or becoming deceased. But if it has an actual end date, he's paying her until January 1st, 2025, we lack the 36 months continuance. It's more pronounced on child support when he's paying her until the child turns, let's say, 18 years old, and the child's already 16 years old. So it's not one or the other, it's both. This is one of the most uncomfortable conversations I have. Let's say someone's been divorced for 10 years, and she says, I can show you 120 months of canceled checks. He's been paying me. This is my income. But if it ends in less than 3 years, I still can't use it. So tough conversation, but you folks in the legal side really would benefit to know these dynamics because it really is at the heart of a lot of these approvals or sadly declines with divorcing parties. The key here is that we have to deem this support as stable and as agreed within that 636 guidelines. Now, it does bear noting there are a couple of HUD programs that will allow 3 months of historical receipt, still need the 36 months of continuance. I prefer you use the 6 months as a baseline because not everyone qualifies for and or desires the HUD programs. Now, moving on, one more distinction I want to make here because it does happen a lot in divorce is that there's 2 different types of refinances in terms of categories that lenders assign. We have what's called rate and term, and we have what's called cash out. Rate and term is more attractive from both a qualifying perspective as well as a rate quote perspective, but it limits the borrower to $2,000 or less in cash out when all the smoke clears. Cash out, on the other hand, a bit more limiting on how much equity you can tap into, not priced as well as far as rates and fees, but it has unlimited amounts of cash you can get within the parameters here. And so imagine in this situation, you have someone, let's say they have a property value of $500,000, they already owe $400,000, and the outspouse wants half of that $100,000 equity. So the in-spouse is seeking a loan of $450,000, right? The first $400,000 to pay off the existing lien, the additional $50,000 as half of that $100,000 equity that the outspouse is seeking. Let's say she makes a phone call to a mortgage professional, and the professional says, well, wait, you're already at 80%. before you get that 50,000. You want the 50. Now you're at 90%. And that 50 is a lot more than 2,000. You don't qualify, right? Because you want the cash out amount, but you're in violation of that max LTV of 80%. You're declined and you have to sell your house to make your out spouse whole. That's not entirely true. And those of us, especially the CDLPs, are trained to go deeper into the Fannie Freddie guidelines. There is a way to call a divorce equity buyout a rate and term refinance, despite the fact that we're clearly giving more than $2,000 in consideration to the out spouse. So without going into all the details, because it does vary in different parts of the country, but the baseline information here is that the court orders must be clear, which as attorneys, you know the importance of clarity. We want to address the out spouse's equity buyout amount or percentage of the equity clearly in the homestead section or the real estate section of the divorce papers. Usually the MSA is where we're going to find that. All proceeds to the out spouse must be paid by escrow to the out spouse. Our borrower, the in spouse, cannot see a single penny touch, in this case, her hands. And even once the buyout amount is calculated, our borrower still cannot receive a single penny due at closing. So typically the in spouse will bring in some sort of money at that point in time to make all this happen. Now, all that is great, but if our borrower has not been on title for the most recent 12 consecutive months, the 3 bullet points on top don't even matter. It's automatically cash out. So you can see where a lot of these have a personality of their own. The more important, or the sooner you can get a CDLP and a CDRE involved to do the initial intel, the more we can help you meet your timelines and modify, accordingly. Now, if I just go in real quickly to these numbers here, when we calculated her numbers in August, looking for $400,000, a 2.75 qualifying rate, and we counted the support as income, even though we couldn't use it yet. We didn't have 6 months, but we projected our DTI there was about 37%. Passing grade looked great. We're able to call out an approval. Now, she had, in this case, one other debt, as far as an installment debt, which is her car payment of $550 a month, and one credit card with a balance of $2,000. And as we all know, your balances dictate your payment. Her payment in this case to Capital One was $50. So again, all that contributed to a 37% debt to income ratio. I was able to pre-approve her at that time, pending the condition of us getting 6 months or more of historical receipt of those support payments. So we waited for 6 months to accrue. So you can see we met in August of 2021. The green areas here are the 6 months that we needed to wait to get those support payments, and we reconvened in March of this year. What could possibly change during that time? Well, in this case, we had a lot of changes. Here in San Diego, we had a continued spike in property values. That property value that was estimated at $500,000 now would support a $600,000 value. For ease, I'm keeping the mortgage amount the same, even though there was a pay down during that time, but just for easy math, that $600,000 value with that $300,000 lien now had $300,000 of equity as opposed to $200,000. Therefore, the out spouse wanted the additional $100,000 of appreciation to be split with, in this case, an additional $50,000 for him. So now she was seeking a new loan for $450,000, the $300,000 to pay off the existing debt and the $150,000 for the equity buyout. Now her salary didn't change. The child support was now countable. We can use it now. We have 6 months, but her FICO score dropped from 740 to 670. When I asked her why that happened, she indicated, well, I had to put my legal fees on my credit card. And when he left the house, he took some furniture and some appliances, and I had to backfill those voided items, and I maxed out my credit card. It went from a balance of $2,000 to $19,700. And oh, by the way, interest rates also climbed during that time, as we saw in the initial graph that we went over. Now, she was very adamant that, hey, I pay all my debts on time. Why on earth would my score drop from 740 to 670? Well, she's right on. By the way, this image here shows how credit scores are calculated. Now, this If I went into this deeper, this would be an hour presentation on its own. Just to keep it on the surface here, the green biggest piece of the pie that influences credit scores is the payment history. And yes, her paying on time gave her an A+ on that green section. But look at the orange section. It's almost as large of an influence. This is what we call credit utilization. So on your revolving credit cards, what is the balance in relation to the limit? When we looked at her last year, she had a balance of $2,000 on a limit of $20,000. She was using just 10%. She got an A+ on that orange section too. That's why she had a 740 score. Now, when we repull the credit, because we have to update the exhibits in the file, her $19,700 balance on that same $20,000 credit card was about a 98.5% usage. She kind of failed that section now, and that brought the score down. Now, in this case, everything else was good, so her score still got to a 670, didn't go farther down, but that was the difference in the credit score. Now, this is a kind of a still version of what we looked at earlier. You can see 3 different arrows. The first one here, the initial consultation, you see where those rates were at that time. Then you see when we reconvene where rates had jumped up to, which were further exacerbated by the fact that her credit score had dropped during that time. And then just on that third arrow, this is present day. I pulled this morning before we went live to show you that despite that climb between the initial consultation and our second meeting, rates have still gotten higher since then. So again, all the importance of updating these equity buyout approvals because the market doesn't stop moving because one of our clients is getting divorced. I'm just going to show you really quickly what the rates look like. This is going to be real quick. When we searched originally, we had a rate and term refinance because again, we're going to give all the money to him through the equity buyout on rate and term guidelines. We had that 740 credit score shown. This is what a rate sheet looks like. I know it's very hard to see this. If I add some color to it, we have certain sections. Now, on the left column here, these are all interest rates. So when you ask your loan officer, what's your rate today? We look at you kind of funny. That's why we have about 20 rates on our rate sheet. Now, that left column there where the rates are corresponds mathematically to that pinkish column to the right to just show you the impact on the payments. Rounded to the nearest dollar, these payments don't include taxes or insurance. But the market changing each and every day, what's actually changing is not the rates, believe it or not. What's changing are those yellow and green sections that show the cost of each interest rate. So if you look at this column all the way to the left, you saw rates between 2.25 and 4.75. If there's no other distinction, everyone would just choose 2.25. Why have the other rates on there? Well, you can see in the green section on the right side in those brackets, those numbers represent either the cost to get the lower rates or the credits to get the higher rates. And that red horizontal line just shows that we lenders priced to 100 in the yellow column. Nothing landed on 100 there, but you can kind of get the baseline of how these are impacted. And last but not least on this chart before I move forward, in the turquoise section, remember when you're in math class and the teacher said to show your work? We're showing how we arrived at this quote based on that borrower's individual characteristics. We had a 740 plus credit score, LTV between 70.01 and 75%. That bottom line arrow, that bottom line adjustment was very low, which meant that she was getting very good rates at that time because of her profile. But now we have to take into consideration that her score dropped to 670. When I make no other changes to the criteria other than her score, and we repulled back in March of this year, her rate went to 4.75, because if you look over in the turquoise at the bottom, we're now reflecting that tier of FICO score, and she had a pretty profound pricing adjustment. So rate quotes are definitely going to have an impact or be impacted by credit scores. Now, when I went to re-input the numbers after we reconvene, now we're adding the 450 loan amount, not the 400. Now we're using 4.75 instead of 2.75. Look at the DTI we have now. It's 52%. That's a decline. Well, why did that go up so much? Well, not only did she seek a higher loan amount at a higher interest rate, but we have to factor in her credit card. Remember, credit card payments are tied into the balance. She went from a $2,000 balance to nearly $20,000 balance. Her payment went up by over $400 a month. That put her in a decline mode. and we couldn't approve her. Now, of course, her reply was, is there any way to save my home? I don't want to move. And we're here to provide solutions. So I had to be a bit crafty here. I went in and said, well, let's actually take your loan amount higher. Remember, we were at 400, then we were at 450. Now we're going to 480. Well, why are we doing that? We're going the wrong direction. Well, I'll show you. Went to 480, which put us at 80% loan to value, which is the maximum cash out loan to value. We changed the classification to cash out, which is going to hurt her rate quote. Absolutely hurt her rate quote. And now we're using that 670 score. When we go back in, my goodness, now we're at 5.25, and she has to pay 1 point in cost to get that loan. And look at the adjustments on the bottom, nearly 5 points when you factor in the cash out, the higher LTV, the lower credit score. You might be thinking, Jason, you're going the wrong direction for this client. Well, when we did all the new math, her DTI was just under 50%, 49.897. We're hitting our head on the ceiling here as far as DTI considerations here, but we're able to keep her home. And to do the reason we raised that loan amount, we had to pay off that Capital One credit card and exclude or not count that 493 payment. That's how we're able to help her keep her home. So to kind of summarize, and again, I went over this really fast just for time considerations. Please update your divorce equity buyouts. If a lender called out a pre-approval earlier this year, we just all have to know that they didn't hold that rate back then. They didn't hold that borrower's criteria back then. It's kind of a joke, maybe not so funny joke in our industry, that a loan is like a piece of fruit on the counter. The longer it sits, the more it begins to spoil, because we have to update the exhibits in the file, and people's criteria can change, especially during a divorce. Just as a point of reference here, if I went back and searched today, if you see up in the right-hand corner, this is today's date. The first scenario with her having the 740 score on the rate and term with very little adjustments, she'd be at 6.625 today. Remember, that was 2.75, same criteria not that long ago. And wait for this. What if we went to the cash out with a lower credit score scenario? 7.625 with paying 3 points. Look at those adjustments combined with the higher rates. So ideally, we don't have to look at these kind of not so attractive rates, but it's a reminder that we lenders look at updated criteria and put that against the going interest rates, and we add to those rates accordingly based on these risk assessments. And so that's kind of all I want to go over now. I want to give the back to you, Greg, but we can talk about recessions and rates more if you would like.
So what I'd like to do, Jason, is kind of just talk about timing on some of these items. You had mentioned it's always good prior to writing those court orders or those agreements that the client consult with you. You're the first step. Because if they want to buy out the other spouse, they're going to have to get some type of pre-approval, some idea of their ability to get financing on that house and buy the other spouse out. Or sometimes, they don't have to buy the other spouse out. They're just doing the rate and term because the court order, the agreement or the court order may just say they just want to get the other spouse off the note. So they have to refinance so that person can move on in their life. And maybe they're going to purchase a home and they can't be on another loan. So the timing is talk to you. If you're an attorney or the person that's getting that financing, they need to talk to you right away before anything's entered into the court record and they agree on it. The updates, how often would you say to both the attorney and the borrower that they need to update or check in with you? Or do you check in with them? And keep in contact during that time period?
It's usually preferred that they keep in touch with me. When I reach out to attorneys on behalf of our mutual client and to start sending emails, they tend to charge the borrower. Right. And that doesn't go over well with the borrower. Like, hey, why'd you email my attorney? I just got a bill for that phone call or that email. So I do want to respect those dynamics, and I'm not begrudging anyone's, it's sort of right to be paid, but I want to make sure I'm not, forcing the issue on our borrower. What I would really kind of summarize and recommend is an initial equity buyout approval, like we did in August in this case study here. And then when we reconvened, ideally, now that we had the 6 months, hopefully we didn't have the ink dry on those contracts just yet. In other words, we had an out clause, because in this case, had we had used current rates on that revised scenario, she wouldn't qualify. And ideally, there's a provision that says, hey, we need to wait, in this case, 6 months. We know we can't stop rates from moving. Assuming our in-spouse still qualifies, we have an agreement in place. If she doesn't qualify, we have an out clause. But divorces tend to run longer than just in unpredictable amounts of time, as we all know. So I would say just keep the communication high, but at the very least, don't make a move without initial consultation, because that client might spend thousands in legal fees and court fees fighting for a house they want to keep that they have no ability to keep. And that's a big reason why I went into this part of the specialization in my industry, because I was the one having to break the news to a client who's waving a court order in front of me saying, hey, the judge says you have to lend to me. Respectfully, the attorneys and judges cannot dictate business practices.
Right.
You can't tell us to lend to somebody. And I mean that respectfully, but it's a hard conversation to have. So we don't want to assume. And I know with a population of attorneys on this call, I know this population understands why assumptions should never be made. Let's just dot our I's, cross our T's, get the professionals involved for that intel. The same way you would refer a client to their CPA if they had questions about possible capital gains taxes or things like that. Just get the experts involved, use those pieces on the puzzle that we saw earlier, and get the professionals to collaborate so that we can service our clients on a higher level.
Right. And the second thing, and you had mentioned it in your case study, from the time they began until the time that it was refinance time and buyout time, the equity in the property had changed. And that dynamic can go one of two ways. In the last year, as rates rose, we also had another inordinate rise in the property price values. So in your case, I think it went up $100,000 from the beginning to the end. So we had a discussion about how those values are brought to the attention of the clients and the attorneys at the very beginning of the process, and they have a decision to make. Do we do a full appraisal and pay an appraiser to appraise their real estate out of the gate? Or do we wait for the lender, if there's going to be a buyout, at some point there's going to be an appraiser, because regardless of what the attorney orders or what the clients do to hire an outside appraiser, the bank's not going to use that appraiser. They have their own set of rules and regulations of how appraisers are selected and the format that those appraisals are in. So we'll go over that real quick.
Sure.
Give kind of a rule of thumb for the attorney to be able to guide and the client to know, do I spend, because some of the appraisers are charging between $500 and $750 just for an independent appraisal of a piece of real estate in divorce cases.
Yeah, and that's a great point, and I'll elaborate for that on Greg, is that we've heard of unintended consequences. When the housing crisis back in 2008 occurred, there's a lot of finger pointing as to who caused this whole crisis. Among the blame game went to lenders and appraisers. Government created what's called HVCC, which is the Home Valuation Code of Conduct. Feel free to look it up and research it. But HVCC essentially indicated that lenders and appraisers were no longer allowed to communicate directly, that they might be colluding or coerced for value. So they created a third party between us called an AMC, which is an appraisal management company. So now what happens is when a lender goes to order an appraisal, they have to go through the AMC. The AMC has a list of approved appraisers in a round robin order that are selected based on who's up next in close proximity to the subject property. So we have to go that path. So now what does that mean on a divorce case? Well, if the parties decide to hire an independent appraiser on their own, we'll call that appraisal number one, we lenders cannot use that appraisal for our final loan information because it did not go through HVCC. So if we were to then get appraisal number two through our HVCC protocols, odds are pretty high the value will be different. If the value is different, we have one party that's happy, one party that's not so happy. But we have to use ours for decision making on the loan. Doesn't mean you folks can't negotiate outside of that, But we lenders who are providing that loan are going to follow our guidelines because we have to. And that might create for some very hard feelings, not to mention, as Greg pointed out, 2 different appraisal costs.
Right. And that's where I just wanted to suggest, as a CDRE, we are specifically trained with performing those broker price opinions. So as an attorney or a spouse that may be buying somebody out, there is another alternative. And God bless our appraisers. We love all of them. We rely on all of them to make sure that our customers can complete their transactions, get their loans, and buy homes. But real estate agents, CDREs are trained. We use the same guidelines when we do our broker price opinions as appraisers do. We pull properties within a mile, within 6 months or less. We can't expand those out in certain circumstances if properties are in rural areas or if we can't find enough comps, but we use the same rules of similar square footage, design, and age. And make adjustments to base those and give people a good idea of what those property values are going to come in at. And we're very close to what appraisers are. I would say if you stacked us up with appraisers and another appraiser, we're all going to be a little bit different on our values, but not much. The only thing that we're different from appraisers is a real estate agent. We don't test mechanicals. We don't turn your air conditioning on, and we don't plug things into walls to make sure that they're working. Some appraisers do that. But we are also trained as certified divorce real estate experts. We do stand behind our broker price opinions. We will testify in court, and we're trained to be to provide that expert testimony to the lawyers and the litigants in those circumstances. So you are able to rely on those. We stand behind it. It's much less and typically quicker. Again, we're not trying to keep you from using an appraiser. If you want to, they're awesome people. They do a great job. And please, I'm showing my St. Joseph here. Please bring our values in. Find our values. Don't lose them. But it is an alternative. And I wanted to let you guys know, if you're going to do a buyout and you know you're going to have to spend that money later, think about the alternative of a less expensive and still accurate, usable in court valuation of those properties out of the gate when you're talking up front. So, Jason, I'm hoping that you can throw up the puzzle as we kind of wrap this up and summarize a little bit. If you can throw that in there, because I just want to point out to everybody, there's a reason why there's a specialty for each one of us in the business. You as an attorney that's watching this right now, Jason, who is an amazing lending professional that's specialized in the divorce, providing great services for folks that are going through that circumstance or situation. And us here at Wyndham-Lyons Realty Services on the Showcase team, who have dedicated a large portion of our business to the family law practices. We have a passion to do this, to help people out. But you can see we all interlock together. And in order to serve our clients well, we're part of your team. Jason, myself, you as the attorney, we all work together to make sure that we have the best outcome for everybody in the situation. And you're surrounding yourself with professionals who can make sure that at the end of this process, we like to tell them, we don't want things to happen later that we could have prevented. We're putting bookends on this chapter in people's lives so they can move forward. So again, I love that image that you have there, that we're all interlocked and working together to achieve that for everybody. Jason,
Yes.
If somebody wants to get a hold of you, if I'm an attorney and I need to run some scenarios past you, or I'm a client who may have to buy out a spouse, or maybe they're looking to get a home loan, how do they do that? How do they get in touch with you?
I put this on the screen right now just so it's there, but nowadays we're walking around with a cell phone attached to us almost surgically. So you can always call or text me 619-200-8031. Email, I'll just give my Gmail account just for simplicity. It's jasongordonmortgage@gmail.com. No punctuations involved. Website, divorceloanpro.com. But nowadays, people like to vet you before they reach out to you. And I respect that. I know as a consumer, I vet my professionals. If you go to www.vipborrower.com, that's my electronic business card. It's got hot links to all my online reviews, any kind of social media like LinkedIn or whatever it may be, mortgage calculators, bio on myself, my company, even a loan application. So a great way to download that information into your cell phone. I would say it's better to know me and not need me than need me and not know me, or be able to get a hold of me. That's a great way to reach out to me.
Great. And Jason, also down below for all of our folks that are listening on Facebook Live and YouTube Live, we'll have a link to you and all of your information down below in the comments section. If you want to get a hold of us here at Wyndham-Lyons Realty Services and the Showcase team, we are at 513-468-1911 is our direct line, goes to all of us on our team. We will be happy to help and answer your questions. We will also let you know that if you're a family law practitioner and you need some support or help, our website is Cincy, C-I-N-C-Y, CDRE.com, CincyCDRE.com. You can go on that. You can order documents if you need copies of deeds. If you want a property price valuation or a broker price opinion, you can order it straight through that website. It's a great resource for you and your clients. Feel free to reach out to us. Again, this is Greg Traynor with Wyndham-Lyons Realty Services and the Showcase team, and our special guest, Jason Gordon. Thank you very much, Jason. We appreciate your time and expertise today and look forward to talking with you soon. Have a great weekend and wonderful holidays, everybody, and we'll see you next time.
Thanks, folks.